Let's also bring on board to chat markets Sean Paul Smith, Global Emerging Market Equity Strategist at Deutsche Bank. Sean, hi, morning. The crash in the Argentinian peso has sent the tremors in emerging markets. Would you use this weakness in emerging markets to up your exposure?
At the start of this year, we had a pretty negative outlook for emerging market equities. We were forecasting that for the year as a whole, we were likely to be down around 10% in dollar terms. And actually, we've already seen a drop of about 8%. So at this level, we'd consider our position. But to be honest with you, it still looks as though there is further downside. Not so much because of what's happening in Argentina. I think that's really quite peripheral to the main body of action in emerging markets. I think the real cause for concern is what may happen in China, or what may begin to happen in China over the next few months. And that's really now the core reason why we retain a relatively pessimistic view of emerging markets for the remainder of this year.
John, currency weakness clearly has worsened as we have a Fed meeting also due later in the day. Do you see aggressive tapering worsening the fund flow situation for Asian countries, or is tapering already discounted and has become a no issue now?
My own view is that tapering isn't such a big issue from here. For one thing, the environment for the global economy is actually quite disinflationary. Eventually, the Fed's action is likely to be influenced by the market action in emerging markets and the sell-off that we've seen in currencies, but also by the economic weakness that we'll see, partly as a result of this sell-off in currencies. And we would expect consumption through most of the emerging economies, at least the big emerging economies, to be significantly weaker than people were expecting a few months ago. And eventually that will feed back into the global and then the US economy. For example, demand for commodities, including oil, we believe, is likely to be quite a lot weaker. And that, of course, will take pressure off inflation in the US as well as in the emerging market universe. So tapering or monetary tightening from the Fed is definitely not the reason to be bearish on emerging markets. The real reason is because of concerns about growth going forward.
John, do you see these kind of jerks further denting investor confidence towards emerging markets?
Well, there's no doubt the sort of volatility that we've seen over the last year or so, and particularly the massive underperformance that we saw last year of emerging market equities against developed market equities, particularly the UK, has dented confidence towards the asset class. So we really have a sort of paradoxical situation. Most of the active players, most of the active institutional players in global equities are now very underweight in emerging markets. So if anything, you'd expect a sort of contrarian bounce back coming from these underweight positions as people cover their shorts in emerging markets and sell developed markets against them. The problem is, though, for a lot of retail investors and also what I call end-user institutional investors, particularly US pension funds, they're, if anything, overexposed to emerging market assets. So I think really you have this two-way pull. And I think the volatility that we've seen and the underperformance over time will probably result in further outflows from the asset class, from retail and US pension funds in particular.
So do you still maintain that 2014 developed markets will continue to outperform emerging markets? What I'm trying to gather from you is that do you think 2014 will be a year for developed economies or developing economies?
Well, it's a harder call than it's been. We've been bearish now on emerging markets against developed markets for the past 3 years. And of course, during that time, we've seen outperformance of the US of roughly 70% against emerging markets. The problem now is that the US market, really from the end of last year, from November, December last year, is actually starting to look quite overvalued. And it's very difficult now to argue that the underlying strengths of the US economy and resilience of the US corporate sector aren't priced into equities. So our core expectation for US equities this year is that we'll be roughly flat. And so our view on emerging markets, which is negative, is really based on a negative return forecast for EM. But certainly it's a harder forecast to make than it has been at any point over the last 3 years. And I would tentatively expect outperformance for developed markets against emerging of roughly 10 to 15% this year. So in other words, a much lower level of outperformance than we saw over 2013.
So coming to India then, the current account deficit is under control now. Most pre-poll surveys are predicting a Narendra Modi-led government victory. Can India perform better than its other Asian peers?
Well, India has held up relatively well since the autumn. Part of that, I think, has been due to the two factors you mentioned, namely the improvement in the current account deficit. And let's bear in mind, by the way, that's mainly brought about by import compression. Exports have responded a little bit to the lower exchange rate, but mostly it's been the decline in gold imports and also oil imports as well. That's really where a lot of the improvement has come from. As far as the polls are concerned, I think most investors now are actually discounting that the BJP will get some sort of workable coalition out of the next election. And of course what we've seen in the past in India is that whilst we have seen periods of quite intense reform, often the process tends to be a lot more complex and takes a lot longer to develop than investors appear to think. And I think that could be the case this time round as well. There's also the risk of unintended consequences. If we look at the Land Acquisition Act, which was passed relatively recently, we could see so far that the effect on business confidence, if anything, has been not positive, has actually been negative. So at the moment, I think the Indian market is actually relatively fairly valued. And unfortunately this year, I don't really have a strong expectation in dollar terms of either dramatic upside or dramatic downside for the Indian stock market. I actually think it's going to be relatively dull, which I know is quite paradoxical because you don't expect the Indian equity market to be dull, but I think this year could be an exception.
So John, finally, what happens if we get a split verdict in May 2014?
Well, clearly it's how the BJP wins the election and the degree of support it can get from, if you like, pragmatic regional parties, which is likely to determine the reform agenda moving ahead. I think I'd tend to be relatively optimistic on that front, but I think a lot of that optimism is priced into the market. It is, of course, possible that given that roughly 70% of the electorate in India is rural, and the opinion polls have a history of not being terribly reliable there, that we could see a surprise. But Congress at the moment seems so beaten down, it's difficult to see Congress outperforming expectations by a sizable amount. And I think any surprise would have to come really on the state or regional level. And yes, it is possible there that things could be messier than the market appears to believe currently.